Hi, everyone. I'm Blanca with Huggins Realty,
I'm Mike Jungen, partner of RedZone Mortgage Group based out of Addison.
and today we're going to talk about very special programs for non residents. Mike, what programs do you have available? And is there anything that really does help for those who are non residents?
Yes, so uh, permanent and non resident aliens, we do have some loan programs available for you. Actually, the majority of them, especially for DACA, Deferred Action for Childhood Arrivals. Basically, that means if your parents came over here uh, illegally, so to speak, but you were born here, we can definitely help you out. Um, the loan programs that qualify, that we can get you qualified for, that we can help you out with, would be pretty much all of them: conventional, FHA, USDA, and VA. What that means to you, if you're a first time home buyer, you probably want to look at the guidelines that have the easiest qualification. So you're not having to pull out your hair, put a larger down payment out to get into the house. And so that would more than likely be FHA for you or USDA. USDA requires 0% down payment. FHA requires 3.5%. But the great news is that on these down payments, the down payment for DACA, we can apply down payment assistance for you as well. So that means that your 3.5% can be covered for by the state of Texas, and your closing costs, even a portion of your closing costs, can be paid for to take that off your plate. So we definitely do help non-permanent resident aliens, DACA, as well. It was fairly recently that DACA, you could not get financing, kind of near the middle and end of the Trump administration. That's all changed now. So yeah, we're able to help more people, and some banks you can inquire with your bank if you like. Some banks still choose not to. So even though it's a federal guideline that we can do DACA, we can do non-permanent resident aliens, some banks have guidelines or rules on top of rules. Those are called overlays, where perhaps they've had a certain amount of loans that did not perform well. And by performance, that means people weren't able to make their monthly payments, they got foreclosed upon. So after so many types of loans that they did that way, they didn't have any success, so they stopped doing it and they pulled out of that arena, so to speak. So we do offer those loans. So if you get a no, it's not a permanent no. You just need to find the right bank, and that's what we can help you out with.
Excellent. What about the paperwork? Does it work the same way as any other lending? Is there any other?
Yeah, so there's some additional steps,
Okay.
and this is kind of new, so I'm going to actually read verbatim for you because it's directly from the horse's mouth. Um, for the majority of DACA, the eligible items that we'll need to get from you would be the employment authorization document, USCIS Form I-766. What that's going to do is show that work authorization status, your authorization status is current, um, or USCIS Form I-94, evidencing that you are DACA. That's H-1B status, and evidence of employment for your H-1B status. Again, that's just H-1B is DACA when you're looking at it printed out. Um, or evidence of being granted refugee or asylee status by the USCIS, and evidence of citizenship of the federal states of Micronesia,
Ooh,
the Republic of the Marshall Islands, or the Republic of Palau. Have yet to help any of them, but we would love to. And
absolutely.
but so that's the paperwork that they need to get. So if you don't have you'll need to have a valid social security number.
Right.
Um, but if you do not have like a driver's license or you passport, that documentation I just covered, that'll that'll be asked of you in the process for your loan, and then everything else is just normal qualifying status. So, uh, we will be looking at your employment, we will be looking at your assets. So outside of those documents, the ID documentation, it's qualifying just like a normal just like any other normal U.S. citizen would for an FHA loan.
Mhm.
There's no increase in rate. There's no extra down payment required. Everything's completely the same.
Oh, very nice and
Yeah.
helpful.
Yes.
Okay. So how do we get started with this process, the pre-approval?
Yeah. So the easiest way to get started is to fill out a quick application online. You don't want to put the horse before the carriage. Or, I'm saying that right? The carriage before the horse.
Yeah.
There you go. You don't want to put the carriage before the horse. You don't want to start looking at houses first and then be like, oh, I want to buy that house because I just fell in love with it online. You'd want to talk to a lender, talk to a local lender called RedZone Mortgage Group. Myself or any of my staff would be happy to help you out. And upon calling us, we will answer any preliminary questions you may have. And the way that we go from there is it's a two-step process. Step one is knocking out the application. Step two would be sending in your ID requirements that we just went over,
Paperwork.
including your pay stubs, W-2s, and that way we are able to calculate your buying power and let you know what all type of loan programs that you qualify for, including down payment assistance. And once you are comfortable and you know what your buying power is, and you know, we're going to educate you on what monthly payment is going to be associated with the house that you like. So send us a couple different houses. We'll show you what those monthly payments look like. And if that makes you comfortable and you get all the warm and fuzzies and you want to proceed, then we are going to tag you in. And we're going to start looking at getting you under contract on that house. And from then it's just about a 30-day closing process from there. But yeah, apply and send in your income documents so we can show you everything you qualify for.
Excellent. Mike, what other programs do you have to offer?
We have some really unique income programs. So let's say you just left your job and you started your own business, and you are doing very well at it, very successful, and you're seeing, for at least a year you've been doing well. Typically, self-employed people, if you're talking about old loans being, conventional FHA, USDA, VA, I say old because they like warm and fuzzies. They like 2 years of history. They want to see at least 2 years of self-employment history of you being positive without any major write-offs to average your income together. However, if you are in the business or you just started your business and you're doing very well for yourself, once you've been in business for 12 months, we have a couple different options. We can take all of your deposits over the last 12 months and we can average those together to get your monthly income. So that means we don't look at tax returns whatsoever because you probably don't have them at this point. We're not looking at pay stubs. We're not looking at what you're paying yourself. We're strictly looking at the money going into your bank account or into the business bank account. So we have that avenue for self-employed people. We also have a W-9 program where we can average W-9s together that you're receiving from all your contractors. If you're a contract employee and you receive a lot of W-9s and you've been doing it again a little bit over a year, we can look at that. Or some people have really some people write off a lot of items on their tax returns.
Yes.
And if you write off a lot on your tax returns, then you don't have a lot of income to show. So maybe you've been in business for 5, 10, 15 years, who knows? But you show a loss consistently. Well, we can still help you out. We can do that bank statement average program. These do, the more creative that we're getting with these income, the more creative we're getting with income, if we're not looking at tax returns, if we're not looking at pay stubs, if we're not contacting your employer for verification, they do come with a heavier down payment. So we'd probably be looking at starting at 10% down.
That's not bad.
10% down requirement when you have above a 740 credit score. When you have a below a 740 credit score, it could be anywhere from 15 to 20%. But if you're self-employed and you're doing really well for yourself, then it's a fair trade-off,
Yeah.
because we're not getting into all of your financials. We're not getting into your tax returns. We're not seeing if you're in a payment plan with the IRS.
Right.
So it's a lot easier that way. Um, there is another program that we can look at. It's called the DSCR program, Debt Service Coverage Ratio, where basically if you are looking at buying an investment property, or let's see, like an Airbnb or a vacation home, and you're in the same boat, where your income, you don't show a lot on paper. The actual house will be the income qualifier. So what that means is, let's say you're looking at a property in Corpus Christi or Galveston, Jamaica Beach, and the appraiser is going to go out there, and the appraiser is going to say, all right, well, that rental home, that vacation home, um, the average monthly income on that is 32, that one's 35, that one's 38. So I'm going to average all those together, and I'm say that this property right here will be 33, 3,400 month, $3,400 a month is what we can give you in income. Well, if that's the case, then as long as your monthly payment is below what the average rental income is for that market, that's it. So
Nice.
all we
Okay.
need is a credit score, and all we need is for that ratio to be in line. We're not looking at any income docs whatsoever.
Okay. Is there a 20% down payment on that?
Yes. So
Okay.
so those are going to be investment loans only,
Mm-hmm.
and investment properties do require 20% down.
Got it.
Yeah.
Okay.
But
Nice.
they're a walk in the park. I mean, the
Yeah.
paperwork, it's literally just a credit pull, your ID, your bank account, and the house that you want to buy. That's about it.
Nice. Nice.
Yeah.
So when it comes to creative financing, you're definitely the to-go
Yeah.
person for this.
Like to think so. Yes.
Excellent. What other creative financing ideas can you offer us?
Oh, let's see. So creative finance. So maybe, a lot of times people co-sign
Mm-hmm.
for family members,
Yeah.
on different items. Let's say maybe a vehicle or an apartment or something of that nature. And you did it so long ago, and your family member or friend has been making payments on time, that it's just out of sight, out of mind.
Yeah.
And they just don't even think about it. So if that's the case, you know, some people circle back around and they'll apply for a mortgage, and then we're going to see, you've got a car payment, you've got two car payments, you've got yours, and you've also got this other car payment for $500 a month. And like, oh, that's my brother, that's my cousin, that's my mom, that's
Mm-hmm.
they're making those payments. Okay, cool. Well, if they are making those payments, we need to be able to see that. So um, if it's on your credit report, your lender is more than likely going to require that to be assessed in your debt to income ratio.
Mm-hmm. Yeah.
Applying for a mortgage is not just simply having a credit score. It's also how much you can afford comfortably. We're not trying to put you in a monthly payment that's over your head. And so what that would look like is it's a debt to income ratio formula. It is your current monthly obligations, put those in parentheses right here, plus your future house payment divided by your monthly income. And so um, typically we're not trying to put you in any mortgage payment or anything that's going to be more than half your monthly income. That's ever since 2008, 2009, mortgage industry is learning their lesson,
Mm-hmm.
and they're trying to be safe about that. So when you co-sign for items, those items that you co-sign will be included in your debt to income ratio. They will be factored into your qualifying and your purchase power. So uh, if we can show evidence of 12 months of the person that you co-sign for making those payments, meaning it's coming out of their bank account directly to that creditor,
Okay.
then we can omit that, so we don't have to
Oh.
count it. But if they are making the payments to you, and then you are making the payments to the creditor, then we have to count it against you.
Oh.
So if that's the case, and you have co-signed for like a vehicle, um, I would suggest you look at trying to get that out of your name. Um, Hopefully, by this time, the person that you co-signed for has got their credit up to where it needs to be. If it's been after 6, 12 months or whatever, where they couldn't initially apply for that, or their income situation has changed, you want to look at refinancing that vehicle out of your name and into the person that's actually making the payments. And you know there are hundreds of companies out there that are that help credit challenge people. So if if the house is taking priority in your life and your family is growing and you've got a little one on the way or whatever, and the house is taking priority over your cousin's co-sign Miata. I don't know why I said a Miata, but it's time to focus on the house, and we can put you in touch with lenders that will help you get that out of your name and into their name. So we do run across a lot of co-signed liabilities for people. Um, Again, easily rectified by just showing a clear payment history for 12 months. That way we don't have to count it at all. But if you are making those payments, if you're given the money and then you are making the payment to the creditor, then we have to put our little creative thinking cap on and try and get that out of your name so it doesn't hurt you.
Okay.
Yeah.
Excellent. Excellent. All right. Mike, anything else that you can think of?
What else? So, rates right now, rates are kind of so a lot of people are talking about mortgage rates
Yes.
Currently and how they have been pretty high. Um, it is cyclical in nature.
Yeah.
This is my 22nd year in the industry. This is my third time through this actual rate cycle. Each one is a little bit different, but they're all the same. Rates will uh, increase pretty dramatically, and then they will taper down very slowly. And so a lot of people are thinking that, well, I'm just going to wait for the rates to go down. The problem with that is that everyone's thinking the same thing. And if you are in DFW, if you're in Texas, if you are, well, let's just say if you're in Texas, the data shows that by the year 2100, I know that's far out, sorry, but there was a report released recently that by the year 2100, that uh, DFW marketplace will have the biggest per capita population out of all the cities. Period.
Oh, wow.
If we keep going as we're going.
Right. Right.
And if they're not moving to DFW, they're still moving to Texas, be it for politics, be it for weather. I don't know why you'd move here for the weather, but sure. But whatever's bringing people to Texas,
Yeah.
and the majority of that is their corporations that they work for.
Yeah.
A lot of corporations are moving down here for the tax benefits. So, as even though the rates are higher, it's not stopping the influx of people coming in here.
Yeah.
Period. So right now, the market in DFW, which where we both are right now, the market, you're still seeing multiple offers.
Oh, yes. Yes.
If you're looking at a price point of $200,000, $300,000, $400,000, you're still going to get multiple offers.
That's right. It is still a seller's market.
But
Absolutely.
but not as much as it was when the rates were in the threes or the fours. And so
Yeah.
it's from my perspective, from what I'm seeing, um, sellers are, if you're targeting as a buyer, if you're targeting houses that have been sitting for longer, maybe 30, 45 days on the market, that's something that I would go after personally, because um, more than likely the seller's motivated to move. More than likely they're worried that the house has been sitting on the market for that long. So they'd be willing to help you out with maybe some seller paid concessions, seller paid closing costs that you could use that to buy down the interest rate. Or maybe there's some items with the house that you'd like to address that you can get fixed. So that's another avenue that you'd like to look at, because right now, I'd say, I can't really give you exact percentages, but if you have a $350,000 house, you're probably going to get about 7 to 8 offers on it. Still a multiple offer scenario, But you're, as opposed to when the rates were lower, that was 20 to 30
Yeah,
offers.
your competition was definitely more fierce.
Yeah, exactly. So competition is more fierce, is more dog eat dog.
Yeah.
So what I'm saying is that, you know, that the perfect house probably doesn't exist unless you build
Mm-mm.
it, and even then, when you build it, you're going to find some problems.
Yep.
So, I, right now, I would strike while the iron's hot. Yes, rates are high. Rates will go down. That's it's all cyclical in nature. You're looking at about an 18-month bell curve. So we are at the peak right now. We will start going down. More than likely, when a new administration comes into play, be it, I don't care if you're whatever political affiliation you
Mm-hmm.
are, um,
It'll definitely impact.
yeah, rates will be going down. So get the house now. You're gonna. I'm sure most of you watching this have probably seen the marry the house, date the rate
Yeah.
uh, from your Facebook feed or Instagram feeds or whatnot. Um, get the house and make it your own. That's the beauty of ownership, home ownership.
Yeah.
You're not renting anymore. You don't have to. There's a return of your value. There's a return of your sweat equity. Stop fixing the landlord's fan. Stop putting
Yes.
tile on the landlord. Stop fixing the landlord's porch. They love you for it, but it's not helping you out any. That money that you're applying for rent is just paying off their mortgage. Whereas buy your own house, pay off your own house, fix your own house, make it your own, knock down a wall,
Mm-hmm.
do whatever you want to it.
Yeah.
This is a good opportunity right now to have a little less stress and a little less competition in the market to make that happen.
Yeah. Yeah. You definitely have less people that you're competing against, and you're able to negotiate more.
Yeah.
Sellers are starting to see that their homes do sit a little bit longer than what we were accustomed to.
Mhm.
So now they're getting a little antsy as
Yeah.
to moving it and moving on with their next steps in their lives. So that definitely helps with negotiations, with concessions, with getting a little bit more for your money.
Yeah. And also another thing that seller concessions can help down, I kind of mentioned it, is a rate buy down.
Oh,
So,
yes.
right now interest rates, you might qualify with let's just say hypothetically speaking, you have a 680 credit score. Then we're probably looking at about an interest rate of 6.875 to 7 and an eighth, for instance.
Mm-hmm.
Seller concessions can help you buy that down to. There's a couple different options. We can help buy it down forever.
Mm-hmm.
So we could probably,
For the term of the loan?
yeah, for the term of the loan. So probably buy that down from somewhere comfortable to like a lower six, like a 6 to a 6.125.
Mm-hmm.
Or we can apply those funds to it's called a 2-1 buy down. And what that means is that your 6.875 for the first year would be 4.875.
Okay.
So for the first 12 months, you have a monthly payment that's probably about $250 lower than what the qualifying rate is of 6.8. The next year it adjusts. It's not an adjustable rate, but the next year it'll go from a 4.875 to a 5.875. You have a full another 12 months at still a lower payment.
Mm-hmm.
And then year 3, that is when it will go to the normal rate of 6.875. And the reasoning, the method of madness behind this type of loan program is that um, rates will be going down during that time period. So enjoy, for lack of better words, enjoy your lower monthly payment, and then by the time that rates do roll around, assuming you're making on-time payments of 8 months in a row without getting a new car, without getting a bunch of new credit cards, without charging up all your credit cards to the max, if you just make 8 on-time payments, that typically is going to bump your 680 to like a 720 or 740. A mortgage is the best thing you can do for your credit, and making payments on time on your mortgage is the next best thing you can do for your credit. Mm-hmm. So, if you started in the sixes, you got a brand new house, or you got a house in general, you make on-time payments, you're going to be in the 700s soon. So when it does come time to refinance, you can make that 4.875 or that 5.875 that you've been working with, more realistic and more solid when the rates do go back down. And of course, I don't have a magic ball that tells you what those rates are going to be or when they're going to drop.
Right, right.
But I would say realistically, through the average of my 22 years that I've been doing this, rates have been 4.875 to 5.
Okay.
So I would see us going back down to those levels, not pandemic levels. Pandemic levels.
Yes.
We don't. I don't. Yeah, we don't want another pandemic.
No, no. And
I like the outdoors, but rates aren't going to drop back down to those levels again unless something absolutely catastrophic would happen. And
yes.
the best qualifier for interest rates, if it's not what you're doing on your day to day, is the stock market. If you hear on the news that the stock market's performing well, or if you hear that the stock market's performing poorly, that's going to be a pretty decent indicator on what's happening with mortgage rates. Typically, when the stock market performs poorly, the interest rates are going to go down a little bit or be less pricey. Um, when the stock market is doing well, the economy is doing well. So that's very loose, kind of litmus test for you. Also, oil. If you're an oil and gas person, when unfortunately when people are being laid off from the oil industry, that is when rates are at their lower or at the lower end of the spectrum. Yeah. And when oil and gas is booming, you're going to see higher rates. So there's a lot of different things and qualifiers that go towards that. The majority of interest rates are going to be tied. Well, interest rates are tied to bonds, period.
Yeah.
But if you don't want to get into all those details and all those graphs, you can kind of loosely follow along the other way.
Yeah. Well, which is, all other industries impact our real estate industry directly in many ways. So, which is why it's so important to get a hold of an external lender with creative financing ideas to get you into your dream home.
Yeah. And if it's not your dream home, make it your dream home.
Yeah, we'll make it.
Slap some paint on it. Yeah.
Exactly. And stop paying your landlord's mortgage.
Yeah.
Pay your own.
Yeah.
So.
Don't fix that porch.
Excellent. Mike, thank you so much for taking the time with
Absolutely. Absolutely. Yeah, and again, you can find me at www.redzonemtg.com. We are on Facebook. We're on Instagram, 214-600-8001. You can phone, call, text on the weekend, at nighttime. We do have the staff available for you, and we are here to answer your questions and your questions.
Thank you.
And we look forward to working with you and earning your business. And until next time, thank you so much for having me.
Thank you. All right. For additional details and to get Mike's contact information, check out the notes. And don't forget to subscribe. Thank you.
Ta-ta.